Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Swarup Mohanty, CEO at Mirae Asset Global Investment India, joining in. Swarup, good evening and welcome to the show, and always a pleasure to speak to you. Swarup, let's start with what's happening because we've seen how the year has been. From the dip that did come in the month of March last year due to COVID, markets have really performed well. And in fact, now if you say it's extraordinary, it's like a deadly second wave, rising stocks. We don't know what's happening. How would you actually describe the situation?
Yeah, at the outset, Hiral, thank you so much for having me on the show. It's always a pleasure, as you rightly said, talking to you. And when you look at equity markets, and equity markets are always a factor of earnings. And let's put these earnings in perspective. I mean, there is a pre-COVID era and there is a post-COVID era, and both the eras are completely different as we speak. When you look at the pre-COVID era, of course, there was a fair amount of slowdown which had already crept into the markets and the economy, which was resulting to practically the earnings being flattish. If you look at 4 years prior to that, the earnings of the industry has been practically flattish. Right, that was the base in which we came into COVID, and then came this re-rating, and when you look at the base being so low, and then the earnings coming to play, suddenly there is a reversal of trend. And when you put some numbers in perspective and you look at, say, FY 2021, the earnings were expected to be around 14 to 15%. But going forward, when you look at the overall economy or the expectation of the market between FY 20 and 23, the earnings were supposed to be up by around 40%. And this is clearly because of the low base effect. There is a reason for the low base. And when you look at the 2-3 years prior to COVID, there was a demonetization, there was GST, there was the US-China trade war, and top it up with COVID. So when you put all these into perspective, of course, it will sort of affect earnings as we speak. But then when this year comes in, this is probably the first year when we are expected to be in a normal economic background. And of course, we do expect the monsoon to be decent. When you put these two together, this is the first time when we now are back into a normal playground. And then when you add what will trigger probably recovery is a low interest rate. And we are already seeing the RBI being very, very kind on that part. Of course, we do believe that the forest reserves that are there will and the capability that RBI has shown during this entire COVID period is enough to handle the rupee. The thing to look out, obviously, will be the oil, and we do believe that as Indians, we need to watch that a bit. We are keeping our eyes and ears close on that, and then we are all set for a recovery at this moment. But due to the phase in the market and money coming into the market, we feel that the markets are fairly valued at this moment. And when you look at earnings versus growth and then the possibility of the growth in the future, we don't think it is cheap. At the same time, we don't see it is expensive. Finally, it will be about the growth which India will put into place. Once that happens, the re-rating from here on can happen, is a possibility.
Right. So, taking that into consideration, probably in the month of April, we were amongst the worst performing major global markets in April on the back of the second wave of COVID infections that we saw. However, now again, we've hit new highs, in fact, today as well. And we're clearly rubbing shoulders with the developed ones,
Correct.
pretty much in elite company right now. So with all of this, Swarup, you had the RBI also, once they released their annual report, they came out and said that the sharp rally that we are seeing with regards to equity markets, despite an estimated 8% contraction in GDP in 21, that poses the risk of a bubble. What would you make of a statement like this that the RBI has come out with?
See, RBI always, I think, has been very vigilant of the market, and I think I have not seen an RBI governor so vehemently commenting on the market, which just speaks of how they have been very fleet-footed in their approach. And let's face it, they have been very realistic at the end of the day. But when you look at the overall market as it stands today, there is a reason why it is at this place. And of course, there is a fair amount of not only resilience, but there has been a very sharp comeback in the market. And the reasons are quite clear, and it's very, very apparent when it comes to the overall market. Because when you look at a low interest rate regime, a low interest rate regime is the one which inflates equity markets, the cost of capital being low. And I think the RBI is biggest catalyst for this. And when you put the overall equity listed companies, the listed companies are typically, the leaders in their sector. And let's look at COVID in the right perspective. It has definitely affected a lot of companies, especially the smaller ones. The ones which were dependent on labor are practically the ones which have been dramatically affected. But on the other side, the ones which were following automated processes, typically the larger ones, have really gained tremendously during this entire period. Hence, we have seen a very realistic market share growth for them, and definitely a growth in their business. And that's where you've seen that there has been a clear difference between the organized and the unorganized. Now, when we come to the overall economy being normal, we expect these organized companies, which are typically the nifty companies as we speak, to maintain the lead. So we are not very surprised by this whole thing, and we don't expect that in the larger company segment there is any bubble.
Okay, so do you think India is entering a period of, say, a virtuous growth cycle, and it's the small and the mid cap companies that could probably outpace large cap peers? Or do you think it's the large caps who will continue to maintain their dominant position?
See, Hiral, this is a very, very pertinent question. And every time we see a tremendous rally in mid and small cap companies, this is a very normal question which comes about. But the nature of mid and small companies are such, when you put the entire overall free float in the market, the mid cap and small cap companies don't need too much money for a rally for a rally to happen, or the prices to fluctuate. You really don't need much money compared to that of the large companies. But let's put this in perspective. The last time we saw such a tremendous rally was in 2014-15, when mid caps practically ran away with everything in the market. Similarly, we saw post-COVID, right? And so when you look at that argument of mid versus small or large, we don't differentiate between mid and small. Of course, we bring to the fore that always be wary of near-term such sudden growths, and that should actually deter people in a way. But normally people follow near-term performance, and the 1 year upside will suddenly start a lot of arguments for mid-cap. But typically that discussion of 80% of growth happens in 20% of time is more, I think, talked about for mid and small. So to see that the easy money is definitely behind you in the mid-cap. It will be very realistic company-specific growth. The entire market, as it had grown, is not going to happen, is our view. We run very successful mid-cap strategies ourselves, so we say that with a lot of responsibility. And hence, it's when you look at mid-cap and small-cap outperforming, we always recommend that it be a longer-term horizon, 6-7 years, where the returns will be lumpy. And if you are invested, you'll get the lumpiness of the return. If you come in after that, then you have to wait that 6-7 years in the future to get another lump. That's how they are in nature, and that's how they play out.
Right. So at this point in time that we're seeing markets at record high levels overall, do you think a new investor, Swarup, should wait, or would you advise them to start investing slowly, steadily?
See, I've always believed as an investor or as somebody representing an asset management company that the best time to invest is when you have the money. At the end of the day, call is yours, whether you want to invest directly in the market or you have to hire a fund manager to manage your money. If you are investing directly in the market, that's a separate question you have to answer. But if you are hiring a fund manager, there is a reason why you are paying a fee and hiring the fund manager. I would say that as per asset allocation, you should put the money when you have the money. If you feel the markets are a little high, there is always the staggered way of investing. But again, that defeats the basic purpose of hiring a fund manager. The key is to know your risk profile. The key is to know your asset allocation. And if there is a gap in the asset allocation, don't wait for markets. Markets will surprise you. Markets will always outsmart you. don't try to beat the market has been a very harsh realization as an investor all through my life. I mean, whenever one has timed the market, more often than not, you've been wrong. But if you want to invest directly, then those are questions which you need to answer. But when you are taking a mutual fund route, then leave that to the fund manager would be a personal advice.
Advice. Right.
Let him be responsible for the fee he or she charges you and take that responsibility of ascertaining whether this is the right time to buy or right stock to buy. That's why you're hiring him or her.
Absolutely. So what would your recommendation be with regards to asset mix right now, taking into consideration equity markets are at life high, commodity markets are seeing a rally as well right now. Debt market again is another avenue that everyone has been pounding on. What would your view be across?
The asset allocation is a personal thing, and everybody's asset allocation differs because everybody's goals and purpose of investing are different. So it is very important to arrive at that mix. That is probably the easier part. The tougher part is to hold on to that mix and probably review and rebalance it at the right time. A lot of wealth is created by rebalancing the portfolio than we give it due, actually. So when you look at the assets, and very interesting thing, if you look at the underlying assets over the last 5-6 years, if you go beyond the capital markets and look at the fixed asset perspective, the rules regarding asset classes are also changing. I mean, no longer is, you can say that real estate is a definite earning proposition in front of you. Prices in Mumbai are probably 25% lower than what they were 7-8 years back, and the government is had actually come out and given you an incentive in the form of 2% in stamp duty. It had never done that in the past. So the rule there, gold, we've seen how it's changed. You cannot just buy and say that you'll make money. Similarly, equities, the horizons have only increased, and the number two bigger fact is, active fund managers' performance vis-a-vis benchmark is also a question which is arising, and hence the growth of the passive business around you. No longer can you say that, okay, large caps are definite buys or a mid cap is a definite buy. Hence, the reason of the cyclic nature of the market, and hence the logic of being asset allocated. Now, the big story of global equity or international investing is coming in as the investors mature. So the typical way of investing is to have a good core portfolio and a satellite portfolio. The core portfolio, both on equity and debt side, should give you the stable return, which are made of solid, good, large companies, which are sustainable in nature. And in the satellite part is where you aim at taking tactical calls to enhance your portfolio returns. So typically on the equity side, it would be the large or multi-caps. I'm talking about it from mutual fund perspective. And the satellite could be, some tactical calls on international investing, say any sector or theme which you think like, maybe a little more aggressive on the small cap side. It depends upon you and your plan. On the debt side, the core would be, say, the corporate bond fund, the bank and PSU. If you are a little aggressive in nature on the tactical side, you can go up a little higher on the credit side or the gilt side and form a portfolio. But once you form that mathematics of that portfolio, the key is to stick to that mathematics, fix a period when you will review that portfolio. On that review date, if there are any changes in the mathematics, just rebalances ruthlessly.
Okay.
That's a proper way of investing, in my opinion.
Right. So overall, right now, if you see with regards to markets, the kind of FI driven money that we saw from last March, it was a FI driven rally completely.
Correct.
In the month of May, Swarup, FIs have offloaded equity worth almost around 6,000 odd crores. Are you expecting a trend to reverse? Because clearly DIIs are the ones who are supporting the market. So is this a case of once bitten, twice shy?
No, I don't agree from an FI perspective. See, from an Indian story, we feel the growth to abhi baki hai. The growth story is yet to come, right? So, and FI flows always will follow growth. So, India's story from a growth perspective is a given. When the globe is practically gone to zero growth, we are still one of those few countries which is showing some growth. You can debate whether the growth will be 2, 5, 7, whatever, or 17, 15, whatever. But the growth is definitely there. So the flow of money of FIs will remain. But the great part which has happened is the DI support. Earlier, if you go back to my early days of my career, it used to be the FIs. If FIs are not there, one or two government institutes would be pulled in to support the market. But I'm very happy to say this, that as a mutual fund, as an industry with an SIP book of over 8,000 crores a month, we ourselves as a very powerful a monthly DI in place. So the structure of the DIs have changed. We don't expect any outflow or any massive reversal in trends on the FI side, on the equity side. But on the debt side, if the interest rates on the US hardens, which also is we don't expect a big possibility, but if it does, then we could see some outflow on the debt side. On the equity side, we see the trend continuing as it was. Maybe the amounts might taper a bit, but the trend of FI's inflow will continue.
Right. So as you mentioned about, what happens in the US and how it could impact the fund flows in the emerging markets, overall, what's the sense that you have? Because there have been concerns on both domestic and the global front. Besides the spike in COVID numbers in India, announcements of lockdown in several districts, there is a concern over the rise in bond yields in the US and the domestic market. So again, there is a feeling in the market that if the bond yields in the US rise further, it may impact the fund flows. Are you expecting bond yields to rise further, taking their liquidity position into consideration? And another aspect that everyone is looking at is the inflation there.
See, when you look at this entire perspective, you have to keep in mind that it is being run by the virus, this entire situation. And the unfortunate part is the virus is also mutating, right? Just when we thought things were getting back to normalcy and we were getting back to work, this second phase has been far more severe than the first phase. But when you look at the second phase, there was a very good, what can I say, upgradation in our thought towards COVID, though the strike has been more severe than the first case. The businesses have upgraded. There has been far more, what can I say, in tune with the economy businesses. A lot of houses have now accepted this as a norm. I mean, just 2 days ago, we've seen the change in, say, one of the large auto players now deciding to deliver cars directly to people's houses. So business models are changing. But yes, if this continues a little bit further and we continue this lockdown phase, there is definite impact on the economy, and there could be, impacts worldwide. Why just the US? Right? We come from South Korea, where we are seeing some, and that's been a country which has controlled COVID fairly well. We are seeing some impacts going out there. So there is a possibility on that. You cannot take anything off the table, but it will be completely dependent on the virus. Though at this moment we do have a vaccine in place, we do have a little more tracking on the virus in place, but still very difficult to predict unless there is a solution or a definite medical solution to COVID on the table.
Right. So, Swarup, overall, right now, taking the equity markets into consideration, what would you take away from the quarterly earnings that have been reported so far, and where are you seeing value?
See, actually, when you look at the quarterly earnings on this date, typically March is a very normalized quarter every year. And then, the phase 2 of COVID came in. So April to June, the quarterly earnings will remain muted, right? But as I said, some of the businesses have now graduated to understanding the virus. Some of the businesses are definitely upgrading themselves to the new norm of this entire business cycle as we speak. And going forward, we do see that good companies with good management. Of course, there has been a very big shift to large companies persisting or surviving this onslaught. So there could be a little bit of shift to larger companies in the aftermath of COVID. But the key is to remain focused on the long term. We don't look at April to June as much of a major impact because of the overall sort of environment. But if the old tried and tested rule of staying invested in good companies, and this time a little bit on the safety amount to a larger companies will yield the desired sort of result. From a value perspective, we see good value across the market. Typically, our house call is on private financials, to be very honest, and IT definitely. From a sector perspective, we do believe there is potential in healthcare and pharma, but it's not a blatant buy like it was last year. One has to be very selective. It's no longer cheap. The easy money again is out of healthcare. But we also believe that in some of the ESG companies, we might find some good value. So broadly, that's where our value picks are circled around.
Right. And very lastly, Swarup, for Indian equities, the long-term structural liquidity support is hard to ignore. If hypothetically, if there is any correction that we could see, do you think it will be a longer one, or do you think these will be short-lived corrections and short bouts?
See, I have in my life gone through 5 severe market crashes. And every time we have seen that when a good asset is available at a good price, money is not an issue across the world. India is a secular growth story, in my opinion. So if that growth story is available at a good price, like we saw in March and April, it will be a very serious comeback, unless there is no solution to COVID. That's a separate issue. I'll keep that completely aside. But between the first wave and second wave, we've already seen the market adapting to COVID. If this asset called India is available at a certain price on a discount, there are enough takers in the world. So make no mistake, if there is another, there won't be another April for sure. I mean, it happens, it has happened 5 times in my working life of 26, 27 years. If there is one more, then you should sell other classes to buy this asset class called equity.
Absolutely. And that's a good positive take that we've been hearing as well. Thank you, Swarup, so much for joining us on the show. Always a pleasure to speak to you. I hope you enjoyed the conversation as well. Thank you. Speak to you soon again and stay safe.
Thank you so much for having me here.
Thank you.